The year is 2006 and Spain is riding high. The economy has been experiencing incredible growth since the turn of the millennium, with per capita output having more than doubled in just 6 short years. German economists are predicting in as little as 5 years, Spain will overtake them in per capita income and Spain will become a central power in Europe. Certain regions of the country were achieving full employment and the government passed laws to make working conditions very comfortable and rewarding. The boom was fueled by a belief in the continued growth of the beautiful country and everybody wanted in on it. The Eurozone opened up international investment in a shared currency, and the best way to own a bit of the Spanish success story was to own a bit of Spain. Buying a beach house in Marbella or a studio in Madrid was not a luxury, it was a savvy investment that could also be used to enjoy some time in the sun. Real estate agents were doing so much business that they became local celebrities, and tradespeople were in such high demand to build enough houses to keep up that it wasn't unusual to see a plumber driving a Bentley. This all became a self-fulfilling prophecy because as money poured into the country and people took on debt to get more exposure to the Spanish real estate market, there was more need for construction, which made GDP figures look great, which in turn made the country look like a great investment. Of course, it wasn't. And the economic shocks of the GFC and the Eurozone crisis put a swift end to the debt-fueled party, and now, almost 2 decades later, the economy is still poorer than it was back in 2007. Unemployment remains high, especially amongst the youth. Broader economic activity has stagnated, the country still struggles with debt, and perhaps worst of all, this slowdown didn't even make the housing market that started this whole mess cheaper for average people. Spain is genuinely one of the scariest economies in the world because while it's easy to look back at this speculative exuberance of the early 2000s and conclude with the benefit of hindsight that it was inevitably destined for failure, the country in many ways had a less over-leveraged economy back then than a lot of major nations do today. If Spain is a cautionary tale, it's probably worth asking if we've really learnt anything from it. So, what drove the rapid growth of the Spanish economy? What really caused it to all come crashing down? Why has it stayed down for so long? And finally, are there major economies in the world today that are really in more compromised positions than Spain in 2007? As we reflect on Spain's economic rollercoaster from booming growth to sudden downturns, it reminds us of the importance of managing investments wisely. This aligns perfectly with today's sponsor, Trading 212, which offers advanced yet accessible investment tools. Trading 212 helps you manage your financial future effectively, letting your money grow rather than lose value to inflation. Even just holding your euros in a Trading 212 account gives you 4.2% interest. You can also use the Pies and Auto Invest tool to set up diversified portfolios automatically. This means you can spread out your investments into multiple companies to reduce risk, and your dividends are reinvested automatically, growing your money consistently over time. And if you're not sure which companies to invest in, you can look through popular investors' pies to either copy their entire spread or take bits and pieces to adjust it however you like. But I particularly like that they offer multi-currency accounts with exchange rates capped at 0.15%, among the lowest in the industry. This is ideal for someone like me who is consistently managing different currencies. So sign up now at Trading 212 using the code EE, make a deposit, and you'll get a random fractional free share worth up to 100 euros. The link is in the description, or use code EE to start investing today. There are a lot of economic roller coasters in Spanish economic history. From their overuse of gold during colonisation, to their exclusion from the US Marshall Plan revival, to early liberalisation policies, there's plenty to discuss when it comes to Spain and its financial history. But to get to the bottom of the country's present crisis, it would be best to start off with its apparent success story kicking off in the 1990s. At the time, the country had a high unemployment rate that wouldn't budge. The Spanish government started making moves to secure a potentially more profitable seat at the progressively globalised table, and they felt the best way to do this was to join the European Economic Community, or EEC. This seed, planted in 1986, was initially underwhelming, as Spain's GDP per capita remained about 72% of the average EEC member. However, after enduring a global recession in the early 90s, the government successfully managed to curb inflation and managed to budget enough to start a steady decline in unemployment by the middle of the decade. Almost in tandem with these changes, the EEC was integrated into the first pillar of the newly formed European Union in 1993, prompting Spain to be one of the first nations to adopt the euro in 1999. As is often the case with most massive geopolitical decisions, like changing a nation's currency and joining a global aggregate, this came with a number of costs and benefits. When an economy remains independent from outside arbitration, there's a bit of flexibility that comes along with it, primarily total monetary sovereignty. If the currency needs to be devalued to boost exports and shrink trade deficits, having a government capable of doing so on its own can expedite the process before things get out of hand. If they need to control interest rates to handle inflation, debts or unemployment, they maintain that control within the country itself. Of course, on the other hand, there are plenty of pros to come along with a more integrated economic model, especially among countries sharing the same continent. For starters, sharing a currency like the euro makes trade with neighbours a lot easier by simplifying price comparisons, as well as helping individual businesses and their consumers find the best prices. Plus, in most cases, a shared currency is a stronger currency, especially compared to the previous Spanish peseta, which was not notorious for its stability. With a huge network of countries keeping a currency relevant, paying for imports becomes a lot easier, and most importantly, credit becomes much cheaper, which, depending on how it's handled, can easily join the list of cons. Alright, so how did this all play a role in what kicked off the Spanish bubble? And how did this country grow on paper to the point of convincing almost everyone it was on its way to becoming the new Eurozone superpower? According to most economists, the dramatic shift was first initiated in 1998, just a year before adopting the euro. Banking on an immigration increase that started the same year, Spain became very interested in the housing market, more than it already was. With a wave of new people ready to gain citizenship, the focus on constructing comfortable living spaces began to rise. This was seen as a positive development for the Spanish government because construction is a labour-intensive occupation, one that could keep citizens employed for long periods of time, and given the troubling history of Spanish unemployment, it makes sense why Spain began to theorise that this could be a long-term solution to the stubborn unemployment rates faced in the 20th century. At the peak of the construction boom, one can find historical references of blue-collar tradesmen driving luxury cars because their work was so in demand. And the fuel on the fire of this boom was the euro. Of course, this is where the cheap credit comes in. With low interest rates provided by Spanish banks, along with the euro acting as a prime catalyst for transactions and low-risk foreign exchange fluctuations, the property market became a wellspring for those hoping to turn a profit. The interest in building houses was already favoured by Spain, but the introduction of the euro made development much faster and easier than ever before. It also didn't hurt in the eyes of both foreign and domestic investors that the Spanish government favoured tax breaks in the real estate sector. These policies decreased the user cost of ownership and made the country an incredibly attractive investment opportunity. There was non-taxation on imputed rents, the basically untaxed capital gains, the mortgage interest payment deduction, and what truly set Spain apart from the other players at the time, payments on the principal were also deductible from personal income tax. All of this, with the economic growth model prioritising construction, caused Spanish borrowing in the real estate market to reach jaw-dropping heights. So, why didn't the Spanish central government see the writing on the wall, and why didn't the rest of the global investors buy into this give it a second thought? After all, debt was climbing dramatically, and in hindsight, economic indicators were screaming trouble. Well, first, it's important to understand that people now look at this from a post-crisis lens. It's kind of like how most experts saw Bernie Madoff as the Wizard of Wall Street, only now coming out to say that everyone should have been wiser. That said, there are other major elements that hid the growing bubble, one being the unique way the Spanish government and its economy function. The official theory is fiscal decentralization. The process of shifting the responsibilities of revenue collection and expenditure execution from the central to subnational authorities. What this means is that the Spanish central government played little to no role in the borrowing process like other countries in the EU. In fact, as far as the world was concerned at the time, Spain's debt was incredibly low because most economic figures only look at the central government and take no account of provincial government branches. In an effort to guarantee the autonomy of the regions that made up the country, the Spanish government set up a constitution promoting administrative division activated in the late 1970s. The nation is made up of 17 autonomous regions, including the archipelago of the Canary Islands in the Atlantic Ocean and the archipelago of the Balearic Islands in the Mediterranean Sea, as well as 2 autonomous cities in northern Africa. Of course, it was clear that construction firms, investors and regular people that just wanted to buy a home were doing all the borrowing, but what wasn't clear was who exactly was doing the lending. This is where the whole issue of regional autonomy comes in. For a country like Spain, a lot of tax collection, health costs and educational funding is not operated by a central authority, but rather its respective autonomous regions. Moreover, before the 2008 crisis, there were approximately 45 different regional savings banks, known as cajas, scattered across the country. Most of them went all in on real estate with high hopes of making it big. This disconnect is one of many that allowed Spain to actually report a budget surplus when things were running smoothly, and for a time, the world just didn't notice. Again, with EU membership, there was also reduced legal barriers to investment coming from other European countries, so it wasn't long before investments from wealthy countries like Germany, the UK, and France began to pour in. This chain reaction fueled an aggressive building boom which made the country's economy look great, which in turn made investors even more excited about the economy's growth, which made them invest more money, which made the country's economy look even better. At its peak, more than 12.5% of the Spanish workforce was involved in construction. Spain alone managed to create more than half the new jobs in the European Union, creating more houses than Germany, France, and the UK combined. Credit began to explode and house prices soared by 71% in just 5 short years between 2003 and 2008. And here's where things get really interesting. Spain did, in a small way, anticipate the possibility of a fallout. After joining the Eurozone, Spain's central government had a team working around the clock collaborating with banks to set aside money for potential non-performant loans when things were profitable. This was very abnormal in the pre-crisis West, and the official record indicates that they set aside about 35 billion euros. But here's the problem. It wasn't nearly enough to save the country from what was to come. Not even close. So what were the key issues here? What really caused it all to come crashing down? Well, to start, like any good relationship, communication is key, and that's an area where Spain was sorely lacking. Immigration was one of the primary initial motives for housing development, and a reason to put many to work on construction projects as quickly as possible. It turns out that Spain overshot their estimates for exactly how many homes were needed, and that's a bit of an understatement. Putting it into perspective, by 2006 the country had constructed more than 800,000 homes, all to house about 200,000 families. To add to this chaos, some participants in the Spanish housing bubble didn't even go through the trouble of changing regulations to suit their needs, they just lied. In a paper published by two professors, Jose Maria Rea and Jose Garcia Moltova, the two studied the nature of the Spanish mortgage system to understand house prices. They did this by looking at the loan-to-value ratio, or LTV. This ratio is computed using the value between the mortgage, which is given, and the value of the house. Seems simple enough, but there was a problem. The disconnect became more elaborate because this value was determined by outside speculators, appraisal companies. Their job was to provide pricing for the homes according to a set of characteristics, and that's how it works according to the study. The Bank of Spain has estimated that an LTV equal or lower than 80% is a good mortgage because of the fact that 20% of the value of the house has already been paid. However, the closer an LTV is to 100%, the riskier the mortgage is, and the higher the probability of not paying back the debt. If the bank was facing a mortgage with an LTV higher than 80%, it was unlikely that the Bank of Spain would accept it. This is where Rea and Moltova made a gut-wrenching discovery. Banks actually managed to give mortgages that were not following banking policy, and here's how they managed to do this over and over again. If a financial worker noticed that a family had an LTV closer to or equal to 100%, they would just call up the appraisal company and change the price of the house, giving the home a lower LTV. According to these investigators, the appraisal company raised the price of the house so the bank could give them the mortgage, the buyer could happily enjoy his or her new home, and the Spanish bank was none the wiser. Of course, this was possibly the most dangerous involuntary risk a regional bank or Caja could make, giving mortgages to clients that had no security with high-priced real estate manipulated by appraisers and financial institutions, frankly too hungry to consider the consequences. And amongst 80% of Spain's population as homeowners, this all felt like a dream come true. That is, until the bubble finally burst. With poor data and incentivized deception, everything finally came crashing down in the blink of an eye. By the time everything in the housing market imploded, Spanish real estate debt equaled almost 50% of the country's GDP. Thousands of families were unable to pay their massive debts, and since the homes were well into negative equity, banks had no way to recoup their losses. The once seemingly bountiful flow of credit dried up almost immediately, leaving speculative developers, which were ubiquitous at the time, to devolve into a large mass of non-performing loans. Needless to say, that €35 billion nest egg didn't do too much. Now again, this is all easy to see as a bit ridiculous with the benefit of hindsight, but there are a lot of countries in the world today in arguably worse positions who have also fallen into the trap of assuming it can't happen to them. For example, my own home of Australia now has a higher level of household debt to GDP than Spain did right before its generational crash, accounting for 116.6% of the country's nominal GDP in March of 2023, compared with Spain's all-time high of what now looks like a rather modest 85%. The increase in the Australian household debt-to-income ratio has been more pronounced than in most other countries, rising from the bottom half of the distribution across advanced economies in the late 1980s to the top quartile by 2018. There are also the same key warning signs of generous tax policies for real estate investing, banks willing to look the other way to get a deal done, migration-fueled speculative mania, and a self-assurance that just because we have nice beaches, our homes should be worth 15 times national income. Then there's Canada. As of the end of 2023, Canada's household debt to GDP ratio was estimated to be 104%, which is again higher than Spain's ever was. There are also the same anecdotes in a lot of these modern economies about tradesmen making much more money than their professional counterparts with more training, and real estate agents getting their own TV shows. Spain's meteoric house price rise in the early 2000s now almost looks relatively conservative compared to the house price increases experienced in these economies over the past 5 years. And as nice as it would be to say that things turned out just fine for Spain, the reality is that it is still dealing with the fallout of this crisis almost 2 decades later. Initially, Spain did what many countries do when they're trying to revive their economy. Put simply, when in doubt, spend it out. And spend they did, spending more as a percentage of GDP on stimulus than any other European country. All of this would have probably been front-page news for years if it weren't for another country stealing the spotlight with its own financial failures: Greece. For Greece, in 2009, the new government then disclosed that Greece's fiscal deficit was far higher than anyone thought, bond markets started to lose confidence in Greece's economy, and they became the new headline. In many ways burying the cautionary tale of Spain's real estate for nearly 2 decades. Obviously, this didn't suddenly nullify the Spanish problem for Spain itself. Just because the world's eyes looked away from the falling tree doesn't mean that the Spanish people weren't still there to hear the sound of the fall themselves. There are a number of serious challenges the country still deals with to this very day. While most Western nations took a beating at the start of the 2008 housing crisis, Spain's system was hit particularly hard, and even though they managed to see a few years of growth, their GDP still hasn't recovered from where it was in 2007. When the country was flying high in the 90s, annual salaries competed with the likes of France, Germany and the UK. However, now it stands far lower than most other developed nations at €29,113 on average. An annual income that is about 9 to 11% less than what they were experiencing before the crash. With the steady rise in debt and inflation, the average Spaniard is worse off today than they were 2 decades ago. With increased international borrowing and the bailout of Spain's banks, the nation was forced to modify the structure of all but 2 of the aforementioned 45 cajas referenced earlier in the video, making it harder for people to access credit even to this day. Moreover, its ties to the euro, a once promising move for financial stability, removes much of Spain's ability to depreciate exchange rates. This, in tandem with lower incomes, saw what economists refer to as brain drain, the emigration of highly trained, intelligent people from a particular country, which, as it turns out, doesn't bode well for a nation requiring problem solvers. The days of blue-collar workers riding in sports cars are also a fading memory, as unemployment remains higher than in most other European nations. As of April 2024, there's been an upward trend. In fact, the stats can be somewhat misleading, as many of those deemed employed are actually just working small gigs to make ends meet, with no promise of long-term career opportunities. Of course, it may be too late for Spain, and the country will need to grow back slowly if it's to do it at all, but for other countries there's always an opportunity to change these habits, and this is where the message becomes crystal clear. With these common themes popping up in other nations, it's time for those to look at what Spain really is, at least from an economics perspective. It's more than just a country with a struggling economy, astronomical youth unemployment, low growth, and ironically high housing costs. It is, in every sense of the word, a warning. A warning that an economy cannot solve fiscal problems unilaterally with one sector assuming mass amounts of debt. A warning that excitement can eclipse rational judgment. A warning that if a housing crash like this can happen in Spain, it can happen feasibly anywhere else. Fast money is exactly that, fast money, and it can disappear just as quickly or faster than it arrived. Now, Spain's neighbour Portugal experienced a similar set of challenges, but they're trying to rebuild their economy in a unique way that looks like it's working but hasn't been particularly popular. You should be able to click to that video on your screen now. Thanks for watching, mate. Bye.